Don't forget to subscribe, like, and hit the notification bell. Okay, everybody, it's Kevin Wadsworth here from NorthStarBadCharts.com. It's great to see you, and thanks for joining me. So, what I want to talk to all of you about today is gold, silver, and the US dollar index in particular, but also how that relates to major market risks that are developing and major market events that I think are headed our way. So the implications for precious metals interest me in particular, but of course stock markets and cryptocurrencies as well. So I want to dive into the charts and just give you an idea what I think is going on here, because I think you're probably aware of the fact that gold has reached the target that we suggested around about a year ago. And the US dollar index is now nearing the target box that I've put on the recent posts there. It might have seemed a bit crazy last year when I suggested the US dollar index was heading to between 110 and I think I said about 113 or 114. That was met with a lot of skepticism, but of course we're just about at 110 now. And I think looking at the charts, it's fairly clear where the US dollar index is likely to go. So as I say, let's dive into the charts and take a look at what's going on. I'll share my screen. You just give me a moment to do that. Okay, that's the screen sharing switched on, and I'm just going to switch my camera off. I don't think you need to be seeing me throughout all of this. Right, okay, so here we go with the silver chart, and this is just a reminder of the long-term silver roadmap and the fact that it is guiding us faithfully towards the target area. But notice that there is support. The main support here is down near $28. And should the markets decide to do something a little bit bonkers, then we could potentially see the price of silver coming all the way down here to the 3-year moving average and the red support line here, which is all the way down somewhere near $25 or even a little bit below. The 3-year moving average is actually 24.65 at the moment. So in a severe market panic, that is sort of the type of downside you might be looking at. Just keep that in mind as we go through here. This is the gold chart now. And gold, this is the gold week, sorry, beg your pardon, the gold monthly chart. And it's on the log scale. I'll just pop it onto the weekly time frame. Just also pop it onto the line chart, I think, as well. Sometimes it's useful to show it as a line rather than candles. Now, on the weekly time frame, the stochastic RSI is turning up here, which is a bullish sign. If I just pop it back onto the monthly, you notice the stochastic RSI is actually dropping. So the higher time frame momentum is to the downside, but the lower time frame or the shorter time frame momentum is to the upside a little bit. Okay, so that's all very interesting. But the point to note here is that if you join together the 1980 high, the 2011 high, that takes us to exactly where we are at the moment. So this is clearly a critical price point, sitting at somewhere around about $2,700. And so the question arises, are we going to see a huge upside breakout here, taking us into a new precious metals bull era imminently? Or are we going to see this pulling back and dropping further? Now, if we look at the US dollar index, it gives us some clues. So there we have that gold chart on the top here. Again, this is the weekly time frame. So you've got the weekly line chart here for gold, and you can see a couple of things actually. One is that the measured move that replicates this move here to this move here is pretty much done. The energy that was released at this move back in 2020 has been replicated on the breakout here, and that was the target. And other techniques, including Fibonacci extensions, gave this target somewhere close to $2,800, which is actually where we got to in the end. So having hit that level, does it make more sense to spend a longer period of time pulling back and consolidating beneath it, or do you think we're just going to sort of blast through that level? Well, that's not an easy question to answer, but if we look at the US dollar index, DXY, it's offering up some clues. And what can we say about DXY? Well, this view of DXY on the log scale, and you can actually analyze it on log or linear, both have their plus points, I suppose, but I prefer to use log scales because they most of the time, in fact, all of the time, log scale works in technical analysis. Sometimes linear works if the price hasn't moved very much. Um, so there are some occasions where you can get away with using a linear scale, but on the vast majority of occasions for technical analysis, you do need to use a log scale. So that's what this is here. And you can see the US dollar index when it breaks down. So it did so in sort of 1985, leading to a long sort of bear market for, sorry, uh, so yes, it led to a long bear market for the US dollar index. So the US dollar index fell from 1985 all the way down to 1995 before rising and then dropping again. Now, interestingly, during that period from the 1980s all the way through to the 1990s, gold did not um, have a massive rally. The rally for gold actually occurred prior to 1980. So the rally for gold occurred during the 1970s, and then during this period from 1980 through to 1985, gold plunged, and then from 1985 through to the end of the 20th century, gold kind of didn't do anything very much. It sort of trended slowly downwards and sideways. Okay, so the next cycle, or the next upwards part of the cycle for the US dollar index, lasted for longer than the previous one. Okay, from the low to the peak, it lasted longer. And during this upwards period from 1992 to the year 2000, gold continued to struggle. Okay, so gold didn't really go anywhere during that period. Now, it wasn't until the year 2000 when this broke down strongly that gold went into a big bull market. So the question is, why did gold go into a big bull market in 2000, in the early 2000s, but it didn't in 1985 when this broke down? Obviously, there's more going on than just the breakdown of the DXY that controls the price of gold. And we'll show you that in a moment. But the answer actually is the reason that gold had a big bull market here, but not 1985, was because this was a capital rotation event in the early 2000s, and this one wasn't in the early to mid 1980s. This was a capital rotation event in the 1970s. Okay, and that's why gold had a huge bull run there. And in the year 2000 and 2001, 2002, that was a big capital rotation event. I'll explain more about that in a moment. But now, since 2008, the US dollar index has put in the longest period of higher lows that we've seen during the period that the DXY has been tracked, or the data has been available. So a very long period of at least 900 weeks there, where or well, it will be 900 weeks, I think, by the time we peak. It's currently somewhere around about um, 878, something like that. I suppose, depending on when it peaks, it could be 900 or it could be a little bit more. But certainly a very long period of time that the DXY, the US dollar index, has been putting in a series of higher lows, higher low, higher low. This one here actually back tested and made a slightly lower low, but it just turned back up again and confirmed this is a support zone. Well, we've got these two black rising lines. Anyway, the point now is that I think I know where the US dollar index is going, thanks to this chart. We've got a horizontal resistance zone that meets with this rising trend line, the channel that we're in at the moment. And that could be anywhere stretching from 115 to 120. And quite possibly, I think the target is going to be close to that 120 level later this year. It could be in just a relatively short number of weeks, maybe a couple of months, or perhaps a little bit longer. But certainly, I think the target seems likely to be in this zone stretching from 115 to 120. So in other words, my target for DXY is perhaps a little bit higher than I've been showing the target box in my recent posts that you have probably seen. Okay, so we've established that DXY is in an uptrend and likely to go a little bit higher. And if we look at the DXY in another way, analyzing what happens to gold and oil when DXY breaks out like this, well, you can see in 1981, gold and oil plunged when DXY broke out. And then again in 1997, 1996, gold and oil plunged when the US dollar index broke out. And in 2014, once again, the DXY broke out in a major way and gold and oil plunged. And the same thing happened in early 2022 there. Gold and oil suffered badly as the DXY broke out. So what's happening now is a fairly major and clear breakout here for the US dollar index. And so it would be going against the evidence to think that gold and oil are not going to fall significantly at this point. So the evidence from this chart suggests that, particularly if we have a rapid upwards movement for the US dollar index, that the pressure is likely to be on gold and oil. Now, it's remarkable how gold, and to an extent oil actually, have held up in the face of this rapidly rising US dollar index, with the US dollar outperforming its peers very strongly. It just goes to show that the other forces controlling the prices of gold and oil are very strong as well. You know, it's not just how we price gold in US dollars and the fact that US dollars are sort of inflating away, if you like, you know, through loss of purchasing power. It's not just that that's controlling the price of gold, but the supply and demand and bullion bank buying and all the rest of it. So that underlying strength for the gold market has completely overpowered the negative effects of a rising US dollar index. And of course, down here in 2008, gold was around about $1,000 or so. And the DXY has risen from where it was then, somewhere near 72, to where we are now, near 110. And gold has gone up by about $1,700 as the DXY has risen. So DXY up and gold up. This is the milkshake chart that I produced for Brent Johnson at Santiago Capital, Santiago Fund, I should say. So you can find Brent on X, of course, and Brent's milkshake theory has had quite a lot of coverage over the years, and this is my technical representation of Brent's theory, because breaking out above approximately 114 here would put us into what I would term the milkshake zone, which is where we move into the top right-hand corner of this red geometric arc. And that's where you tend to get a more rapid upwards acceleration. And in fact, we're already seeing a pretty rapid upwards acceleration now. So movement into this zone above 114 towards 120 puts us in the milkshake zone. And if we break out above 120, then things could get really kind of weird. I think it's a question of how far the US dollar index can go before something breaks, and not just the US dollar index, but the yields. Now, the yields are interesting because the 10, 20, and 30-year yields are all looking a little bit like this. So breaking out of very long downtrends, breakout, consolidation, breakout, consolidation, and now in the last few weeks we've had another breakout. So the 10, 20, and 30-year yields are all breaking out, but when you look at the 1 and 2-year yield, they're not. And when you, in fact, the 1-year yield, I think it is actually looking weak and breaking down. And when you look at the shorter end of the yield curve, like the 1 month, for example, they're plunging. The 1 month yield is literally sort of falling off a cliff at the moment. And that takes us to the final chart here, which is one that we should all be aware of. And I've been publicizing this for quite a long time now. And it's the yield curve inversion chart. So because the long end is rising, so in other words, the market is pricing in problems with inflation in the longer term, but the shorter end of the yield curve is dropping. That means that the 10-year yield minus the 2-year yield is rising because that number, the number on the 10-year yield is getting bigger at a faster pace than it is on the 2-year yield. I hope that makes sense. So when you do the 10 minus the 2, the number has turned positive. It was negative and it's turned positive. Now, when that happens, you can probably see quite quickly from the chart here, when the chart was interacting with the zero line or below it, and it rises above, not only do you get a recession shown by these green shaded zones, but you also get some sort of geopolitical event that is later given a name, either related to the markets or related to, as I say, geopolitics. So some sort of nasty event seems highly likely, as we are now rapidly rising in terms of the 10-year yield minus the 2-year yield. Plausible deniability and distraction are how I phrased it. In other words, no doubt someone's going to come up with some sort of distraction technique to divert us all away from what the hell's going on. But what the hell's going on is really a creation of the central banks, the Federal Reserve. This is a man-made disaster that is coming our way through the manipulation and misuse and manipulation of the markets, of the financial markets, and interest rates and all the rest of it, and borrowing and debt burden and all that kind of stuff. So we have a high likelihood of a high impact event continuing to be suggested by this chart. And so we've got the US dollar index rising rapidly. We've got the yield curve uninverting due to those rapidly rising 10, 20, and 30-year bond yields. No doubt the unstable nature of the debt sustainability comes into this at some point, with huge mountains of debt and rising interest rates on large portions of that debt. Then debt sustainability becomes an issue. And so the net result of all of this is, and the chart that we should always refer back to is, if I can find it, I might just have to click on here to find it, but is the yield, sorry, I beg your pardon, the capital rotation chart. So the capital rotation, I'm going to show you the chart in a moment, but the capital rotation indicator is on 10 out of 16. I've just modified this. We did have 12 pieces of evidence in this equation, but now I've increased it to 16. So capital rotation occurs when all of these boxes turn red. So gold is the measuring stick for all of these. So money supply is broken down versus gold, or gold is broken out versus money supply. DXY is in a bear market versus gold. CPI is in a bear market versus gold. PPI, currency in circulation, the equal weighted S&P, the New York Composite Index, the Dow Jones, the Wilshire, and the Russell are all in a bear market versus gold. We just have the SPX and the NASDAQ to go. And when they enter a bear market versus gold, we will be confirming a capital rotation event. This is a capital rotation process that is underway, and the capital rotation event is confirmed when all of these boxes turn red, including when the S&P breaks down versus money supply, when the S&P breaks down versus the US dollar index, when the S&P breaks down versus CPI, and when the S&P breaks down versus currency in circulation. Why have I chosen all of these metrics? Well, because in every previous case of a capital rotation, all of these boxes switch between green and red. And I'll show you that using the gold versus SPX chart. And this, again, is illustrating capital rotation. And I'll just get rid of a couple of things on here to make it clearer for you. Let me just do this. Okay, so the capital rotation occurs in both directions. The rotation can take place in an upwards direction, and that's when gold is outperforming the S&P, and the rotation can take place in a downwards direction, and that's when the S&P outperforms gold. So we can go back to the year two. In fact, we can go all the way back to the 1920s and 30s with this, but let's just confine ourselves to the year 2000. The rotation event took place and was confirmed with a breakout and all of those boxes turning red. And that capital rotation event took place, and we had 10 years where the stock market went nowhere. It initially plunged, then it took many years to get back to where it started. And in the meantime, gold doubled and then doubled again and then doubled again. Well, it went from $250 to 1,900. So you can do the maths on that. It doubled to 500, then it doubled to 1,000, then it pretty much doubled again to nearly $2,000. And then we had the breakdown, and the rotation occurred in the opposite direction. And we had a period from 2013 to 2021 when the stock market, when the S&P outperformed gold. Okay. And then from 2022 to now, gold is slowly starting to outperform the S&P. And in fact, you can go all the way back to 2018 there, you go back 6-7 years, and effectively the whole thing's just gone sideways, which means that both gold and the S&P have performed equally over that 6-year period, because both are in a bull market and they've matched each other's performance. But you can see what's likely to be happening next here. You can see the way this is trending. We're already getting a series of higher lows on the on this ratio chart. This is the ratio of gold to the S&P. So as this chart starts to move up, it tells you that gold is outperforming the S&P, and we will be entering a precious metals bull market and an S&P bear market. And eventually the S&P will start to move up again, but gold will be outperforming it. So it takes us back to this table again, and this will be when the S&P box turns red. That's when this ratio chart breaks out and gold breaks out versus the S&P. And same thing for the NASDAQ. When gold breaks out versus NASDAQ, that box will also turn red. So we are in the process of a capital rotation event. If you want to be sure with your investments in the sector, gold, silver, and the miners in particular, you wait until the capital rotation event is fully confirmed, because this process period where the boxes are still in the process of turning red, you can get volatile sort of turbulence, really, if you want to put it that way, as the process takes place, because it depends what type of market event is going to happen as this ratio breaks out. And this ratio won't break out because gold is soaring in particular. It'll break out because the S&P is rolling over. That's the way it works. You know, the S&P breaking down is required for this ratio to break out. Just purely the movement of gold itself won't be sufficient. The S&P needs to start breaking down, and that's what pushes this ratio to the upside and gets the capital rotation process going. And when it happens, just as on all previous occasions, the S&P is likely to fall 50%. Other stock indices like the Wilshire, the Russell, the equal weighted S&P, the New York Composite, the Dow, they can fall further. And in particular, probably tech stocks and the NASDAQ are prone to falling in excess of 70 or 75%, in excess of perhaps as much as 80% or so, possibly even more. So that is how the capital rotation process works. And that's where I think DXY is going. And that's a good reason to remain somewhat cautious on that gold chart that I showed you right at the start. Although it's looking like it wants to break out here, one scenario could be that gold is so strong that it breaks out and moves up to, say, 3,000 or 3,200. And then the capital rotation event takes place and it comes crashing all the way back down to support. Now, that would be an incredibly bullish outcome if that were to happen. Extreme strength being shown by gold if that were to happen. Probably a little bit more likely, in my view, given what's happening with DXY at the moment and bond yields, is that something starts to crack pretty soon, and gold starts to sniff that out and has maybe a modest pullback. I mean, it could find significant support around 2,500. There's significant support around 2,500. If the 2,500 area fails, then that opens us up to anywhere between 2,100 and 2,300. Okay, so we have to be mindful of that. Breaking out above the 2750 area with some conviction would change the outlook for gold, but it wouldn't change the outlook for the capital rotation event. The capital rotation event is approaching, and just how turbulent that turns out to be for gold and silver as that process happens remains to be seen. It's a somewhat risky period, but gold certainly at the moment is showing plenty of strength. As I said, though, I would err slightly on the side of caution here. Gold has reached its measured move target, and I suspect it may take longer to digest that as the capital rotation event itself unfolds. And we may well see gold pulling back a little bit further at this point. I know that's probably the minority view at the moment, and I see a lot of analysts are pretty confident that gold is going to go up pretty much directly from here. It certainly could do that, but I just want to, give you a potential warning that with what DXY is doing, that could throw a spanner in the works. So with that, I'm going to conclude this podcast. I hope you found it interesting. If you did, pop it in the comments there. And I will think about doing another one at some point in the future and making it public. This type of analysis is done, of course, all the time for our website members. We've got a market roundup podcast coming for our members later on today. Right, that's it from me for now. Enjoy the rest of your weekend and speak to you all again very soon. Bye bye for now.